Hello and welcome to yet another episode of London Eye. My guest today on the show is Timberlake, who heads global emerging markets at HSBC and runs a few $1 billion in emerging markets, including India. Nick, thank you very much for your time today. First, you run a fairly significant sized BRIC fund. Has there been any disenchantment of late, any disinterest that you've noted because of how these markets have performed? As a theme, would you say that it's on the wane?
Yeah, I'd say the BRIC countries in the short term have had a tough time of it. And some people have decided that, you use the words on the wane, that maybe the best is past for BRIC. I would argue somewhat differently. I think there's really a fantastic opportunity for those markets today. And if there's an issue that we face at the moment, it's trying to work out which of the markets we like the most, because we like all of them. They offer really fantastic value relative to a broader list of global emerging markets. And in many cases, the companies that we can invest in are generating much higher returns than you might find more broadly across the emerging markets. So, the markets are, as we all know, they go in cycles, and sometimes certain themes are in favour, and sometimes certain themes are out of favour. At the moment, as you say, the BRIC theme is not one that you'll get a huge amount of interest in, but often those are the times when the best opportunities occur to make money.
So have inflows slowed, or have there been redemption pressures as well?
No, we've had redemptions in our BRIC product for most of this year. Not enormous, but we've had a steady trickle of redemptions. I think it's fair to say in recent times we've started to see a bit of interest in terms of investor interest, in terms of flows back into the BRIC fund again, but I'd say very early days. Not just BRIC, some of our other individual country strategies that go to make up BRIC and the wider GEM, also a little bit more interest in very recent times.
But you think all this talk about how markets like Indonesia, Philippines, Turkey will continue to do much better than the bigger BRIC economies, you wouldn't agree with that point of view?
No, I mean, we invest across a very broad range of countries in our mainstream emerging markets funds. We have potential to expose ourselves to about 25 countries. And then there's another 40 countries that we're interested in here at HSBC, which we call the frontier markets, that we can also invest in for our mainstream funds where liquidity allows. And, from time to time there are countries which exhibit more attractive valuations. I think the way we think about things is we're always considering where the best value is, and we do that through the lens of profitability. So we're thinking, which companies exhibit the highest levels of profitability for the valuations that you have to pay. And there are some markets which have risen quite strongly, which have caught investor attention, which we still like. Turkey is an example of that. And then you'll find that actually the majority of markets at any point in time tend to be the ones that we like, tend to be the ones that maybe have fallen out of favour with others, and the value has started to appear, and that's a good time to be buying again. And India is an example of that, where in recent times actually that market started to perform a little bit better.
What role would commodities play in determining your choice of emerging markets this year? Because it seemed more likely that some of this recent fancy towards India is because commodities have fallen. By the same token, Brazil and Russia have appeared less attractive.
Yes. I mean, again, just coming back to what I said before, we're always thinking at HSBC about, where's the best value relative to the profitability. So it might be that commodities are falling out of favour and we like them or dislike them, and vice versa. It could be that they're back in favour and we like them or dislike them. It will really depend on that combination of valuation and profitability that we're focusing on. Now, as you say, India is a beneficiary to some degree of some of these commodity prices falling. So they're a big net importer of oil, and with the oil price off about 10% since February, that's having some benefit both to the Indian current account picture and also to a lesser degree to the fiscal deficit as well, because there's quite a lot of energy subsidy taking place in India today. In terms of, are we trying to avoid or increase exposure to commodities, we tend not to think about it in those terms. We're not taking a sort of active bet or view on, is the oil price going to rise or fall? Is the price of other commodities, aluminium, soft commodities, whatever it might be, rising or falling? We'll look at each individual security and we'll look at its valuation, and that will draw an overall picture for us. So actually, as it turns out at the moment, we have quite a lot of exposure to energy companies around the world. Some in India, some in China, some in Russia, some outside of those countries. In the materials or the direct sort of hard commodity space, it's much more stock specific, and we don't have a sort of strong view overall on the whole sector, I would say, as things stand today.
In your BRIC funds, are you overweight India, or is it just in line with the benchmark?
Yes, so look, the benchmark is quite lowly weighted towards India. So the first thing we do is we say this is not a good way to invest. We should reset the benchmark so that each country starts with at least an equal weighting, and then we'll work out what we like more or less on that basis. And as it stands today, actually, we're marginally overweight that equally weighted 25%, but much more overweight any benchmark that investors might follow. We have about 27% exposure to India today, which actually is about as much as we've ever had. If you think about our global emerging markets portfolios, where we have a much broader list of countries, actually India is one of the largest exposures that we have today. I think one of the advantages that India has is there are a lot of companies there. So, you know, you can go to a market like Russia, but there's actually only a few handfuls of large liquid companies that we can invest in. In India, there are more than 70 companies in the MSCI index, although it's maybe not one of the largest countries. And in that environment, you're always going to find companies which exhibit an attractive combination of valuation and profitability, and we find quite a lot of those today in India. So it's a market, I'd say, that we like today, and we've liked for the last 8 or 9 months.
So that overweight has come at the expense of which other BRIC market?
So Brazil's the one we like least. I said at the beginning we like all of these markets, so it's a matter of liking least rather than not liking. That's the one where we find it most difficult to find value. And in fact, the Indian market, the Chinese market and the Russian market, we really like all of those markets. As a whole, the Indian market doesn't look as attractive from a valuation point of view when you take the entire market as one. But when you drill down into the individual pieces, what you find is quite a polarized market. So there are some companies and some sectors which maybe look quite stretched valuation-wise, and then there are other companies and sectors which are exhibiting good value today. So there's a sort of mixture.
Yeah, the problem though is that, well, I take your point, many fund managers point out that the companies that they want to own in India belong to the category which is not very inexpensive, which is your consumers, private banks, those kind of names. So are you hunting down the value chain at better value?
Yes, I think we're maybe a little atypical in that respect. As you say, I think most people who are investing in the Indian market would prefer to go to the high growth areas which maybe feel a bit safer, where there's maybe less political regulatory risk. I'd say we're not that typical on that basis. We're happy to invest where there's a bit of controversy, as long as we understand exactly what that controversy is, or we've at least been able to work out the sensitivity of the company's profitability to, you know, if things go one way or another way, and we'll obviously think about, you know, what the worst case scenarios are before we'll invest. But yes, we have exposure to, you know, financial services companies in India, and there are a number of issues there. We have some materials exposure. There are a number of regulatory issues there that I'm sure you're very familiar with, and also in the energy space. In fact, those issues seem to be going more in favour in the last few months. There's been some reform progress there.
What are your thoughts on the Indian IT companies?
We don't have so much exposure to the Indian IT companies today, and the reason is because we see so much good value elsewhere in these sectors that I just mentioned to you. So, yeah, I'd say that's not an area that we are particularly focused on. We're much more interested in trying to find value in the energy space, in some of these materials companies, and in the financial services area.
Another area where valuations are tempting but the outlook is not quite clear is anything to do with the investment cycle, anything to do with infrastructure. Have you walked into that, or your conviction is not very strong?
Look, we have some companies which are exposed to growth in infrastructure, where we're watching quite carefully the whole infrastructure story. The problem in India is that many of these infrastructure companies, although they may be growing their top line quite fast, when you look at the profits that they're generating, it can be quite limited. So that's a frustration, I think it's fair to say, that investors maybe, you know, in previous times we've seen excitement about the infrastructure growth and the spend that might be picking up there, and then it hasn't actually materialized in terms of profitability. I think the government, you know, they've got a lot to do in India, and you know, we need to see exactly how things develop in terms of new infrastructure spend. There's a fiscal issue that they're trying to deal with, and there's the whole issue between the states and the central government, and we have elections also coming. We're not quite sure when yet, but certainly we're on a sort of 12-month view. There will be elections in India, and that will have some impact, I think, on the government's focus on the actual economy, and maybe distract them into thinking about how they're going to get re-elected.
At this point, a quick break. We are back with London Eye in just a minute. Welcome back. You're watching London Eye. I've been in conversation with Nick Timberlake of HSBC Global. Are you confident that we've seen the worst, broadly speaking, with earnings in India, and they will now start to accelerate, or is the timing uncertain of the recovery? I think
it's difficult to talk in general terms about so many companies in terms of the earnings trajectory, but overall we see earnings growth this year in India of low double-digit, 13%, that sort of level. I think is probably the best that we can hope for. So somewhere between 11 and 13% would be a sensible target. Now, obviously, within that there are some companies that are growing much faster, and there are other companies that are struggling. I would say, though, that there are a lot of businesses in India where maybe there are reform issues which have been overhanging those companies, whether it be in iron ore, in coal, in financial services, in energy, where the regulator, where the Supreme Court, where the government need to do certain things. And with those companies, really, the analyst forecasts are, to our minds, kitchen sink jobs in terms of people have thrown in the towel and said, look, what's the worst case scenario? Let's focus on that, rather than all the other scenarios which may come true. So, would you say that the case for a valuation or re-rating of India is high, or market performance will broadly be linked to the kind of earnings growth that you're talking about? I think, as I said, we really believe very strongly that what drives stock returns is sustainable profitability of companies, rather than earnings growth per se. Those companies have to generate that profitability in a sustainable way. And again, talking about such a broad range of companies, it's difficult to say how the overall market will do, but actually, we're quite constructive on the overall market. Within individual pieces of the market, we are very constructive today. So there are certain sectors that we think are overvalued, others that we think are undervalued, and we think if you don't want to focus on just one bit of the market, you'll probably do better than the average emerging market investing in India. If you're happy to focus on maybe some of the more controversial, interesting valuation aspects of the market, then we think over the next 12 months you'll do far better than the average emerging market in terms of the returns that you generate. Is the emerging market story a bit of a hard sell right now? Because so many people seem so enamored of the US and Japan increasingly. Are they willing to take on that extra risk to look at markets like the BRIC markets, for example? So investors, they go in, as you say, they go in cycles. And there's been a lot of focus on Japan. And Japan's really a market that I've been investing for more than 20 years now. It's been out of favor for, well, more than a decade, and suddenly that has attracted a lot of money, maybe out of the Asian region so far in 2013. There's clearly a lot of value in the Japanese market, and so I think maybe as a short-term thing that may have distracted investors' attentions, but what it's actually done to our minds is it's created a really fantastic opportunity in emerging markets. It's amazing how investors forget and they change their minds. It was only 4 or 5 months ago that we had a lot of investors saying to us, oh, well, I'd like to put more money into emerging markets, but I feel like I've missed out because the markets obviously have risen so strongly. And we said to those people, look, you're right, they have risen a long way. There'll be a pause. There always is a pause. And we've had a pause. And now, of course, we have the opposite kind of sentiment coming out. Should I be concerned about investing in this area? But I would suggest that now is probably a good time for people to be thinking again about another opportunity in the emerging markets, because fundamentally things haven't changed dramatically from when we last looked, when people were very excited back at the end of 2012. Markets don't go up in a straight line, and when they dip down, everything else being equal, it's an opportunity opening up. What's the biggest risk in your eyes for emerging market equities now? So look, I think most of the risks are actually external risks as they stand today. I think, unless there is a level of economic activity taking place in the world, then emerging markets will find it difficult to generate the profitability and the returns that we're all hoping and expecting. And up until quite recently, we've had a number of the key economic blocs in the world really not delivering. So the US economy obviously has been struggling for a number of years. The European economy as a whole has been finding the environment extremely difficult and is flatlining really at the moment. There isn't a huge amount of economic recovery taking place in Japan either today. So I think if there's some kind of setback again, particularly in Europe, that could be bad news for the emerging markets. And it's interesting if you look at which emerging markets have not done well so far this year. A lot of them have got close ties with Europe. Not all of them, but quite a lot of them, and the companies there have close ties with Europe. So we need to watch that. I think we're a little bit more optimistic about the outlook maybe in the US and also in Japan, given the very aggressive monetary stimulus they've now started. But that's a risk. So economic activity. I think there are a number of other risks out there. Obviously, there are ongoing problems in the Middle East. And we saw just this last weekend unprovoked attacks by one country to another. These kind of things can potentially escalate out of control, and when they do, it can create havoc in stock markets, and emerging markets being less liquid than the big ones, being perceived as being more volatile, will tend to suffer more in this kind of environment. So we have to watch for that.
What's the good scenario for emerging market equities? That growth is not great in the developed markets and therefore in a relative sense EMs stand out, or do you think that has the risk of injecting some risk off in the global system, which may be bad for EMs? I
think there's three ingredients that we should be looking out for when we're investing in emerging markets. The most important ingredient is available in abundance today, which is loose monetary policy globally. So this is the key one, and obviously we've got very, very low interest rates in the developed world. We just had the ECB cut again quite recently their interest rates, and we've also got unorthodox monetary policies taking place in the US. They're printing money in Japan. They're starting to print money very aggressively. In terms of the Japanese economy, actually much more aggressively than the current Fed plans. So that's, I think, from a developed world point of view, very, very supportive for emerging markets. And then when you look at monetary policy in the emerging world, what you find is, look, we probably passed the best in terms of rate cuts. There are a few countries. India, in fact, they cut their rates again last week. And maybe there's room for one or two more cuts if they can get that inflation number down a bit further. My sense is that we've probably seen most of the cuts in the emerging world, and what we're going to see now is interest rates roughly flat. There'll be a few countries where maybe they're just rising a little bit, a few countries where maybe they're just falling a little bit, but overall roughly flat, and at relatively low levels given where inflation is, and that should be supportive. So that's the number one and most important ingredient. The number two ingredient is valuation, and I think from a valuation point of view, the headline is, look, these markets are relatively attractive, but they're not at the sort of bargain basement levels that you might find when we've been at the bottom of a crisis, so back in the global financial crisis in 2008. However, what has happened, and one of your earlier questions with regard to the interest that investors have on certain companies versus others, is we've seen this polarization not just in the Indian market but across the whole emerging world, where anything which is perceived to be relatively safe from a growth perspective, investors have more and more been prepared to pay any price for that, and anything which is perceived to be relatively risky in terms of more cyclical, investors have more and more been prepared really not to accept any kind of price for that. And so the valuation differential between those two categories of companies is really as wide as it's ever been, well, certainly in my career over the last 20-odd years.
Do you see that converging, those valuations?
I think at some point it will. It's very difficult to know what will make it converge. And we'll all but look back when it does start converging and say, oh, yes, look, there it started. But when before it happens, when you see these kind of valuation gaps, it's just an obvious thing to try and take advantage of. So you'll find in our portfolios lots of companies which are maybe in that lower valuation category. And at some point in time, we'll start to see the value coming out. We started to see it actually in some markets like the Indian market, funnily enough. Turkey is another market where we started to see that happening. So those are the two most important ingredients. And then the third ingredient, which you alluded to in your question about growth, I would say is a less important ingredient, but still a prerequisite. We do need to see growth in the world. the emerging markets more and more stand on their own 2 feet. But without growth in Europe, without growth in the US, without growth in Japan, I think that's a tall order for the emerging economies. I mean, China is now the second largest economy in the world, and Chinese growth is more and more important. It's, if you like, the fourth leg in this growth stool. And there have been a few concerns about the pace with which the Chinese economy is recovering. We would say, look, it is recovering. It's maybe not recovering at quite the pace everyone would like, but it is recovering. It's growing at a reasonably rapid pace, approaching 8% GDP growth. It's not bad at all. And the authorities there, we have a new set of leaders in China. They're starting to flex their muscles. Over the weekend, they announced a series of new reforms that they're going to be focusing on over the next 12 months. There's a growth element to those reforms, and I think the Chinese economy may surprise on the upside rather than the downside.
Nick, a pleasure. Thank you very much for your time today.
Okay, thank you.